All right, welcome. Good afternoon, everybody. Thank you for joining us. My name is Brian Humphrey. I'm the Director of Distribution for Advisors Preferred, a sub-advised fund family. We're pleased to be hosting this series of webinars with the theme of From Chaos Comes Opportunity. 2020 has been quite a year so far, but at Advisors Preferred, we're proud to have managers who have fared very well during these difficult markets. It's my pleasure to introduce Ralph Doudera of Spectrum Financial and 100-Fold Advisors today. Ralph and his team have the distinction of managing 3 mutual funds, all of which are 5-star rated by Morningstar. Good afternoon, Ralph. And Ralph might be on mute, so we have to work through these things with the environment that we're in since Ralph is off site. Ralph, you there?
I am. Do you hear me now?
I do. Good afternoon. Thanks for joining us.
Oh, thanks, Brian.
Great. All right. So the format for today will be one of a Q&A session. But first, I'll share a few slides to give some background and preview some of the material that we'll cover. From there, I have a few prepared questions for Ralph that should cover some good ground. After that, we'll open the floor to your questions. And as for your questions, there's a Q&A method through the Zoom interface, the Q&A box. Submit any questions that you may have through the Zoom interface, and we will do our best to get to those at the end of our webinar. Also, we are recording the webinar today, so we can make this available at a later date, should you so choose, and we'll certainly be following up with everybody. So we're certainly excited to get going, but first we have to cover a few kind words from our friends in compliance. And we can check that off the list. And so, as I mentioned before, I'm going to cover a few slides just by way of background and set up some of the material for Ralph. So the first slide that we're looking at is the 3 funds that I had mentioned before. But the first thing I'll start with is the 2 separate brands. One is Spectrum Funds, one is 100-Fold Advisors. And really the difference there is Spectrum is a for-profit enterprise and 100-Fold is a nonprofit enterprise. And what that means is substantially all of the sub-advisory fees earned by 100-Fold are donated through to various charities. And since its inception in 2004, that number is well over $6 billion. So it's really quite an impressive operation. So the 3 funds that we're talking about today, starting on the left, is the Spectrum Low Volatility Fund. That fits in the fixed income bucket, an unconstrained credit fund of a total return variety. Again, 5-star rated in the non-traditional bond category. The second fund moving to the right is the 100-Fold Select Alternative Fund. We see this as a core holding in most portfolios. It is a multi-strategy, multi-asset approach, which we will certainly get into. Again, 5-star rated in the tactical allocation category. And then the third fund is the Spectrum Advisors Preferred Fund. This is an equity offering from Spectrum, and kind of equity at a reasonable amount of risk with the ability to change its exposure to the equity markets based on market environments. Also 5-star rated by Morningstar. I'm going to touch a little bit on each of the funds. The first one here is the 100-Fold Select Alternative Fund. As I mentioned, it has an inception date back to 2004. The share class that was in existence back then has returned nearly 6.5% per year since that time. The HFSAX share class, the investor share class, which is more appropriate for most fee-based accounts, has returned 7.66% since its inception in 2012, and that fund is currently up 26.86% as of the close last night. The Spectrum Advisors Preferred Fund, again, the equity offering has an inception date of 2015, so a relatively new offering, but does have those 5 years. And this fund has been recognized twice by Lipper in terms of its outstanding performance, and it has returned nearly 8% a year since inception. And the Spectrum Low Volatility Fund, and you see the ticker SVARX, you'll hear Ralph refer to this fund as SVARX ever so kindly. But this fund, again, with an inception date in 2013, has returned 7.66% a year on average. The next 4 slides I'll go through kind of quick, but I just want to point out a few items because Ralph's really going to get into this, and that's really why we're all here, to hear from Ralph anyway. So this is a 5-year total return performance of the 3 funds versus the New York Stock Exchange Composite Index. And for the last 5 years, and for the purposes of this call, we're going to concentrate really on this, I'll call it magenta line and the green line, with the magenta being the low volatility fund and the green line being the 100-fold fund. You see kind of that steady, smooth ride that Ralph and the portfolio team strive for. And we love to see also points of market dislocation. Everybody remembers the 4th quarter of 2018, as well as March of this year. And you can see how those colored lines have performed through those times. This is essentially the same chart, except the index here is the ag. And again, you know, it's the same total return line we're looking at, but then you also see points of market dislocation. Here you see the bond markets earlier this year, and in comparison, how did the funds perform during those times? The next 2 slides are allocation charts showing the changing allocations of asset classes within the 2 funds that we're speaking of today, the low volatility fund and the 100-fold fund. This is the low volatility fund, and you see the change in allocation, the tactical moves being made by the portfolio team amongst the various fixed income sectors. This is a year-to-date chart. We do have these charts available that go back further to the inception of the funds and longer time periods. But for the purposes of today's presentation, these are year to date. Ralph's going to get into this much deeper. And this is the 100-fold Select Alternative Fund. Again, with the change in allocations, with this being a multi-asset approach, you can see the different exposures to alternatives, equities, and such as well. So fairly active management going on in the portfolios. All right, so with that, the reason why we're all here is to hear from Ralph. And as I mentioned, I've got a few prepared questions for Ralph to kick this off, and then we'll open it up for questions for everybody on the line. First, Ralph, with decades of investing experience and a history of sidestepping some major downturns, starting with the crash of '87, can you tell us how your history and those events have shaped the type of investor and money manager that you've become today?
Well, yes, I remember 1987 quite well. A lot of advisors haven't been around that long, but I remember the Monday morning of the crash. I actually, before the markets opened, I went into one of my partner's offices and I said, you know, today we're going to have a really bad day, probably the worst day we've ever seen in the markets. I had no idea it was going to be down 22% that day, but I knew it was going to be a bad day. Fortunately, I had a relatively few managed accounts. I was not open to the general public at the time, but I had a lot of family and friends involved in that. And one of the things I had done, I did not believe in buy and hold investing even at that time. But I had a good friend of mine who said, well, I don't really want you to trade my account. I just want you to buy and hold. I want to buy some stocks from you, but I just want you to hold and buy and hold. And that was in August. And of course the crash was in October. On the other hand, her mother-in-law, who was a substantial client of mine at the time, I had her in our managed account portfolio in high yield bonds. And actually that Monday, she called me at night crying on the phone, and she said, "Do I have anything left?" And I said, "Well, yes, we moved you to the money market last week, in the middle of the week, because of the risk elements that were involved." And she was so happy. She was my client until the day she died. Her daughter-in-law, on the other hand, never invested in the stock market again because I wanted to trade the account, but she said no, she didn't want to do that. So I basically said, I'm not going to ever again invest money for anyone without risk management involved. So that's kind of how we started. And I've been trading high yield bonds now since, even before '87. We've got about a 30-year track record, and we've averaged about 10% a year, with the worst year was down about 1.8%. So that's the kind of returns we're looking for, which is, stock market returns without stock market risk. So that's kind of how we got started. After 2000, when Elliott Spitzer came along, we realized that we couldn't continue to just trade other people's mutual funds. So we decided to set up our own mutual fund and trade internally in the fund. So that's when Hundredfold kind of got its start. And then sometime after that, we set up our credit fund, which is credit only. And then a year or two after that, we set up our equity fund. So all of our three funds are risk managed. And that's the only way we want to do business.
Great background. And, it's, for a lot of folks that are investing, there aren't a lot of managers out there that's tenured as you and state, that type of a history back in 1987. So fantastic. I briefly touched on the three different funds that you manage, but can you explain to us your intention as to the design and the use and application for each of the funds?
Yeah, the three funds they're different, and interestingly enough, their performance over a long period of time is very similar, even though we take different routes. They're diversified, and it's to explain them in great detail would be like sipping from a fire hose. So I'm really not going to get into a lot of the details, particularly on the equity fund, but maybe reserve comments to our credit fund and our alternative fund. The credit fund is strictly bonds and fixed income investing. The alternative fund is basically composed of three parts. We found that by diversifying into different asset classes, we can still have low risk, but still get stock market returns, if you would. We're kind of aiming toward that 10% number, which we've been able to do for the past 30 years, and that number has continued, not every year, but certainly over longer periods of time. That's what we do. But anyway, in the Hundredfold Fund, we have a portion of the fund is in credits, which is basically the same strategies we're using in our credit fund, but we have enhanced it to include a 0 to 40% stock position, and in its 10% portfolios, if you would. And they're all traded differently. There's 4 different trading strategies in the fund. Sometimes they're all in, sometimes they're all out. And the third component of the Hundredfold Fund is a commodities trading platform, which gets in. We have about 10 or 12 different commodities which we trade long and short, and that goes from about minus 50% to plus 50% invested, depending on what commodities are doing what. We may be long, like during the crash earlier this year, we were long gold and we were short oil. And that helped our portfolio to make a little bit of money. Although these positions aren't really large positions because we want to be diversified, we don't take any big bets. We take lots of small bets because that's what we want to do. We want to make money all the time. The fund is geared to not be correlated directly to the stock market. And that's the other thing we do have. The third area, which we talked about, which was the bond portfolio, goes from about 0 to 120% invested in bonds of various sorts. So that's kind of our overall snapshot of the three funds.
Got it. All right, and that makes a lot of sense to me. So it sounds like there's a lot that goes into the funds on a daily basis. Can you describe for us sort of a typical day in terms of how do you measure and understand the markets, and then what actually leads to implementing decisions in the funds?
Yeah, typical day, I get up at 6 a.m. and at 6 a.m. I get my first email from Chris, who is our equities and number cruncher here in the office, and he's there working early and working late. So by the time the market opens, I get an in-depth analysis of all of our trading systems and signals. It's about a 20-page report. And on there is a summary page that I can work with. It just basically explains what signals might be close to getting in or out of, and then details if I want more details on that particular thing. We found, like with our credit fund, we monitor about 12 different types of credit investments, from mortgage backs to muni bonds to floating rates to high yields to governments to high quality corporates. It's like the preferred stocks, anything that pays dividends. I mean, although it's not really dividend paying stocks, but we monitor them on a daily basis, and we rank them on a daily basis, and we see exactly which group is performing the best. So we end up moving into the groups that are performing good, and the ones that are not, we phase out of. And it's interesting, when you look at credits, they really don't move together, even though you would think that they're, interest sensitive would be. But, high yield bonds kind of move with stocks. They have about a beta of 0.5, and they do move pretty much like the stock market, but not always like the stock market. And that's one of the reasons we like trading high yield bonds, is because they're trendy, they're low in volatility, they're somewhat predictable, and their return, if you looked at the return of high yield bonds compared to stocks, are probably about 3/4 the return for less than half the risk. So by leveraging high yield bonds, you can increase your exposure without taking on a whole lot of risk. But again, trading high yield bonds, we've had a summary sheet that we get every morning that shows about 6 different trading strategies, from very short term to intermediate term and everything in between. An example of that would be, like a week or so ago, we got a sell signal on one of our systems for high yield bonds, and interesting, today we got a buy signal on that same system. So we move in and out in relatively small increments because we don't like to take big bets. We just don't. We don't think making big bets comes out very well, but taking lots of small bets is a way that we kind of make money consistently. So that's a typical day. We pretty much trade every day something. Very often we don't, we just kind of adjust the portfolios and move in a little bit, maybe increase exposure in certain areas, areas we like, and maybe decrease exposure to other areas that we may not like as well. So that's a quick snapshot.
Well, it's an early start and it sounds like a long day, but based on your results, very fruitful. So keep up the good work. So 2020 has been really an unforgettable year, right? And so can you walk us through? And I'm going to leave the allocation charts up. In fact, I'm going to switch over to the 100-fold one. So can you walk us through 2020 in terms of what were some of the signals that you saw and how they influenced your decisions in as we started to head into February and early March, when everything really started to happen with COVID here in the U.S. And then, how did your thinking change or views change as we neared the bottom towards end of March, and then carry that forward to today?
Yeah, if you look at this chart, it's kind of an interesting chart to see where we were, and we started the year fully invested. If you look at that we had like 120% bond exposure. We had high yield exposure about 75%. So we were actually over 200% invested in stuff. And I say stuff because it's not all the same stuff. We had a little bit of equity exposure as well, like 25% going into the year. And we ended up making some really good money. But the problem that I saw coming up was the fact that everyone was so optimistic. I mean, the tech stocks were running. We had, the taxi drivers were giving me hot tips when I take an Uber ride. And I knew that bad things were going to happen. I just didn't know how soon, how soon it gets out of control. So I call that when we get that love and feeling. We get that love and feeling, and there's nothing you can do wrong. So that was kind of like an indicator. It's not a signal of any sort, but it's just an indication of levels of risk are really high. Then you look back and, like, if you look at the high yield bonds going back and the floating rate funds, the senior loans, they hadn't had a major correction in a long time. There was a lot of talk about leverage on the street, and I just got the feeling that there were so many people that were levered out that the next correction was going to be not pretty. And it was kind of interesting because when the COVID thing hit, it didn't. When it first came out, no one paid attention to it. And I started thinking to myself, the psychology of the markets is just crazy right now. I think we need to be kind of careful what we're doing. So when we started getting some warning signs in February, I said, this is not the time to be a hero. This is the time to maybe be early out the exit door, because I always like to sit at the theater near the exit door so when somebody yells fire, I'm the first guy out. And that's the other thing about our portfolios is that everything we own, we can get out of today. We do not hold anything that's illiquid. And that's kind of a key to our trading strategies as well. If bad things are going to happen, we're out. And if we're wrong and they come right back, we'll get right back in again. That's kind of the nice part of that being liquid is that we can get in and out very quickly. So we got ourselves, actually we didn't get our sell signal when I got out of all high yield bonds. In fact, when I put the order in, Kristen, who executes the order, she said, why are you doing this? Because we hadn't gotten any signals yet. We would have gotten them within a week later, but I said, I just think that bad things are coming our way and we need to be the first ones out. So we got out toward the middle of February of all of our high yield exposure. And sure enough, it just got worse. So then in thinking about what's happening is when you get a meltdown like this in the stock market, it's not over until the last bit of blood is squeezed out of those people who leveraged out. It's like the margin calls are going to come in, the unsophisticated money are going to get stopped out, and everybody's going to get scared. So I said, okay, this is going to be a correction. It's going to be done after a really nasty wipeout, which is exactly what happened. So the week of the low, we got our first buy on high yield bonds. And I remember taking the position. I said, I'm scared. But what's nice about that is that if you're not making big bets, you can take those positions and you can add to them and take them off if you're wrong. And that's kind of our whole philosophy, is that we're not heroes, but we're just going to take advantage of moving into the portfolio slowly and moving out slowly, unless we have to get out really quickly, in which case we'll do that. So that's kind of what happened this year.
All right, it makes a lot of sense. And I'm sure there'll be some follow-up questions there in terms of, the systems and kind of the human feelings that go into it. But it's certainly very, very interesting, Ralph. And so you mentioned, as we put up this slide in terms of exposure, can you walk us through that in terms of how overall exposure levels are determined in the funds, and then how do you use leverage as well?
Leverage can be applied in a couple different ways. First of all, you can buy, like in the high yield market, you can buy CDX, credit default swaps, which are very liquid and very tradable, and you can put a short position on or a long position on. If you have a position in your portfolio, for example, that you want to hedge, you can hedge with that sort of thing. And those you can leverage. They're like almost like a futures contract. You can leverage them out like as much as 20 to 1. You can buy ETFs, the high yield bond, the HYG and JNK, as well as a number of other ETFs. You can leverage them at 5 to 1. We can also purchase other people's mutual funds through a swap arrangement we have with Barclays Bank, where we can actually borrow money from Barclays and put a swap on. We can buy, for example, a PIMCO fund, the PIMCO income fund, or whatever fund we want to there. And they actually make the purchase. And the leverage there is 5 to 1, and we get the performance of whatever that is without it being considered debt in the portfolio. But we're very careful that we don't leverage ourselves to the point of increasing our risk, and we also want to keep that risk in the in the liquid range, so we can get out of something if we have to get out of something. And then we monitor each of these different funds, these bond funds. So again, we rank them on a daily basis. And when things are really good, we'll lever the fund up to 200%. And when things are not so good, we're more cautious. So it's kind of a matter of, we don't have a formula as such. We have signals to when to be in and when to be out of stuff, but we don't have a formula that says how much we should be in. That's kind of like our finesse, that we, just based on our market experience, we want to make sure that we don't overstay our positions. Like going into the elections, we have not levered up as much as we normally might have, because we just don't want to get caught with some weird thing that'll happen after elections. But once that's cleared, we'll put the pedal down a little harder.
Got it. Makes a lot of sense. It sounds like there's again a lot that goes into this on a daily basis. Now you personally have a particular expertise in fixed income, and you mentioned the holdings of other mutual funds within your funds, but you got out a few of those funds earlier in the year. Why did you do that?
Yeah, that's on the mortgage-backed funds. It's kind of interesting. If you look at some of them, they have no volatility. Well, they have no volatility because they're not priced daily. And so you have to be really careful with some of the funds that you're purchasing to find out what's really going on behind the scenes. So we did a little research to find out that there may not be any liquidity. If somebody starts cashing out of those funds, there may not be a buyer out there. So we said, well, as things started melting down, we said, we don't want to be in a position to be the last out of the theater again. So we're just going to take our positions off. We saw the level of risk go way up, and sure enough, some of those mortgage-backed funds had dropped in half. No one would have guessed that. And I had no idea that that was going to happen either, but I just know when the risk gets up there that I don't want to be holding any paper that can't be gotten out of. So that's kind of what happened.
All right, good. And I sense, and I know I keep hearing this reoccurring theme about risk aversion. And I think that that certainly applies to all three funds. It's a risk first, return second. Correct, Ralph?
That's right. Yeah.
Okay. All right, good.
That's my primary focus is that.
Good, good. So let's talk about the rest of the team a little bit, and some different skill sets that come in terms of trading, technical analysis, and the equity and commodity expertise as well. Can you talk about that?
Yeah, we have. Chris has been with us all the years and years and years, and you know, if he could do anything, it would be what he's doing. I mean, he does what he's doing because he enjoys it. So he basically is a very technical analyst and has a lot of different trading strategies that he comes up with. So he pretty much focuses on the equity side. We have Kristen, who is our commodities person. So, and I'm kind of like the fixed income person. So we kind of have diversified those three areas out. Although we can all do all of them, we generally let each person take responsibility for that particular part of the portfolio. So that's kind of a really quick overview on that.
Okay, and I guess by extension of that, is it safe to say that should anything happen to anybody on the team, that the backup and the transition plans in place?
Yeah, I like today. Okay, Kristen's out with COVID, and Chris on vacation. Okay, so I'm here with the team without my normal trading team. This never happened before, but today was the first day. We had a great time trading today, and so it's just everything's routine. Everything. Oh, the signals are routine. The trading sheets are routine. Everything is very organized and easy to execute in someone's absence. So we are adding to our trading team as well right now. So we'll be adding someone by the end of the year there as well. So we'll have another party in there.
Great news. Okay, so the charts that we've shown, aside from, I'll go back to the total return charts here. This one against the New York Stock Exchange. They show again the magenta and the green line with low volatility and 100-fold. They show more or less a smooth ride over time. Now I know we can't promise any results, and obviously you have to execute on your strategies. But is there a targeted return for these strategies? And then secondarily, as you look at the annual returns for the funds, there's much lower years, there's much higher years. How do you explain those?
We don't go into a year having any idea what's going to happen. It's kind of interesting how that works. I mean, I could tell you that if the yield spread on high yield bonds were 10 to 15%, I'd say we've got a really good year coming up here, because we know that that's going to squeeze it back down to the normal 3 to 4% area. But we don't know what's going to happen. We just know that we're going to take our positions, we're going to follow the markets, we're going to use our systems. Our systems are going to work for us no matter what kind of market we get. if you look at these two funds, the SFARC's credit fund, you can kind of expect historically a 2.5% maximum drawdown, whereas in 100-fold, it's about twice that. So there's a little more risk involved with the 100-fold fund for drawdowns, but the performance tended to be the same. So that's just kind of an observation of looking at the performance going back. Although it's interesting, when you have that drawdown of like 2 to 5%, the comeback period is very quick. It's like
19 days.
How many? Like
19 days.
Like 19 days before you hit a new high. So, so I would feel comfortable having someone invest in a low vol fund for 1 year, and the 100-fold fund for 2 years. And
that's good to hear, and a great way to manage expectations. I'll remind everybody listening that we have transitioned into the taking open questions. Again, if you have questions, please submit those through the Zoom interface. We'll be happy to get to those. We are on a time constraint for today, but we'll do our best. Next question, Ralph, is earlier this year, the 100, this is related to the previous question, the 100-fold fund had a large jump in NAV. Although the past years had a relatively steady growth rate, was this a, quote, right time, right place, lucky bump, or was there a modification made to the management of the fund?
Maybe some of all those things. The biggest change we made to the fund this year was, I watch commodities, and I never really trade commodities that much, but they've been in a downtrend for years and years. And, I still watch them, and I'm always looking for other managers who are going to maybe give me a better performance in my fund. I'll buy their fund. But all the commodity funds just were terrible in terms of performance. But I still watch individual issues, individual commodities. And I looked at the charts and I said, I'm seeing a major basing pattern in all these commodities. I'm expecting maybe inflation's going to come back. Darn if the agricultures aren't starting to look like they're turning the bottom with cup and handle formations. And I said, let's increase our exposure to the agricultures. And so we trade them as well now, and we added that to our portfolio to kind of give us a little extra. They're not big positions, but they're still, we can be as much as 50% long in commodities in the fund. So the other thing is that, when oil gets crushed and you're short, and gold goes crazy and you're long at the same time, you're going to make some money on those. So normally if we weren't doing that sort of thing, we'd just make nothing because we were out of everything except stuff like that. So instead of it just going sideways, we made a little extra money, and that's what we're looking for, to add a little extra alpha to the fund without taking on stock market risk.
All right, good. I'm sorting through the questions coming in, and I should note a point that Ralph made, and Ralph, you want to expand on this. You mentioned roughly 30 years of experience and a track record, but the low volatility fund, again, launched in 2013. So the difference there is really, you're talking about the SMA strategy in which the fund was based on, correct?
Yeah, right. We have a 30-year track record of our SMA accounts, but we formed our first mutual fund like 15 years ago, and then 7 years ago for our other fund, and then 5 years ago for our equity fund. We found by using a mutual fund format, we can do so much in the fund. We can use leverage. We can borrow money at 2% and buy somebody's fund that's yielding 5 or 6, and get a little extra return on something like that. We can buy futures. We can buy there's no, like, we can go on margin. Like in an individual account, you got to wait 30 days to by margin, and then you can't use margin on because of UBTI issues with your qualified plans or your charitable accounts. You can't use any form of leverage there. So inside the fund, there's more funds that we can trade. They're all available to us, and it's like fun. It's like there's so many things we can do. There's always something that's doing well, and we're always looking for that other manager that we can buy a position in his fund as well.
Yeah, that makes a lot of sense. There's certainly a lot of advantages in terms of wrapping a strategy into a 40 Act fund. There's just certain things that you can do in there that you just can't do in an SMA strategy. That makes a ton of sense. And and then we'll certainly, when we wrap up the call, I'll share my contact information with everybody. If anybody wants a look at that SMA strategy that goes back, we'd be happy to share that with anyone that would like it. We have time for one more question. We hit on this early in the presentation in terms of the difference between Spectrum and 100-fold, and we talked about the charitable aspect of 100-fold. So that charity is called Simply Distribute. Ralph, can you spend a couple of minutes just telling folks what that's about?
Yeah, we felt like I basically retired 30 years ago, and got back in the business because I wanted to do something other than just enrich myself. So we decided as a firm that we were going to do work, and we were going to distribute all our revenues from that one fund to a bunch of different charities. So that's the way we set that whole thing up. We don't make a nickel on the 100-fold fund. We just give that money away. Now I think we gave over $8 million so far since we set that fund up. So that's kind of my heart, is to do something and to make a difference, and not just make money to make money.
Yeah, and my apologies. I said 6 million earlier in the presentation, so I didn't mean to shortchange your great efforts. So over 8 million since the inception of the fund, and certainly something to be applauded. So we've run up on our time limit for today, and I certainly thank everybody for joining us. Ralph, thank you for your time. I hope everybody found this to be really informative. Again, we recorded this webinar. So if anybody would like a copy, we're certainly happy to share that with you. Up on the screen is my contact information. You can reach out directly to me either via the phone number or my email address. And but also we'll be following up with everybody who attended as well today to see if there's anything we can help you with. The 3 websites that we've been talking about, the 100-fold Select, the Spectrum funds, and Advisors Preferred, the advisor on the funds, are all there for your information as well. So this concludes our series that we had this week. We thought it was very informative, very successful. We'll continue to stay in touch with everybody. And with that, have a good evening.